Hello, everyone. Welcome to the Nasdaq Dorsey Wright podcast for the week ending on March 28th. My name's Ian Saunders and joined again by Jamie West. Jamie, it's back-to-back weeks of
Two
us
weeks in a
sitting
row.
down here. I guess we have left the office over the past week, right? It's
Yes.
not just coming here, but yeah, it's good to be back here. It's been so last week we were talking a lot about some reaction movement from the Fed and then maybe how that relates to the broader picture of global markets. This week, though, we wanted to hit on maybe some other areas. I mean, domestic equities they've had a rough close to the quarter, right? It's been a rough first quarter of the year, but some other areas across the broader markets have seen some notable movement that maybe has taken a little bit of the. I mean, when you get a correction in the S&P, it's like that's all you hear about, right? But there's been some other areas that have seen some notable movement, some to the upside, some to the downside, that we felt it was probably important to bring to people's attention. Is that fair?
Yeah, I mean, I think it's been interesting, at least I haven't looked this morning, but before that kind of pullback we had yesterday, the market obviously had a significant pullback, 10% or so, but there's only three sectors that were in the red, communication services, consumer discretionary, and technology. Everything else positive for the year and outperforming the S&P 500.
And you add those sectors together, and that's the bulk of the S&P from a market cap perspective. So that's kind
Yeah,
of probably why, right?
Yeah, I mean, you have a few very large sectors or stocks kind of dragging down the indexes, but overall, if you just took it like an average of the sectors, we're not doing too bad. And the best performing this year is kind of surprisingly energy.
Yeah. I mean, before we get into energy, though, I think I was taking a look yesterday at the broad spider sector funds on a performance quilt
Mhm.
with the S&P thrown in there. If we stopped performance at the end right now, it would be the most sectors outperforming the market on an annual basis going back to 2007, which is, I mean, obviously there's a lot of months left in the year. We're not stopping performance at the end of Q1, but we haven't seen this many areas outperform the market in several years. It's been a very top-heavy market, and we haven't seen that. I mean, people are looking for breadth, and you're kind of getting it broadening out. It's just maybe not like people expected.
Yeah, I mean, I think there's only so many sectors that can outperform the
Right.
broader market, right? And if technology's outperforming the broader market, that really kind of crowds out a lot of other stuff. So I guess we're kind of seeing the flip side of that right now, which is technology, consumer discretionary, really lagging, and that's opening up the the market for a lot of other areas to kind of outperform the index.
Yeah, and so when you're looking at, you mentioned energy was the best, XLE being the best performing kind of broad cap weighted sector representative so far on a year-to-date basis, up what, over 8%?
Yeah, I mean, well, it was yesterday. I'm not sure what it did yesterday, but
Yeah.
we were up, I think, almost 9% prior to yesterday.
Yeah, I mean that is not probably what everyone expected, especially with what crude has been doing. Yeah, you had what XLE up about 9.5% with market movement through yesterday, and we're recording this Thursday morning, so through Wednesday's action, right?
Yeah.
Um, Not maybe what was expected, and something we haven't seen in a while. Energy still has some pretty weak relative strength.
Yeah, sitting at the very bottom of Dolly, and really nothing you can put your finger on to really say, hey, this is what's driving the rally in energy stocks. I mean, crude oil trading around $70, multi-year lows around 65, 66, and we were just there about a week ago.
Right.
So as to what's kind of driving this strength in energy, somebody smarter than me is gonna have to figure that one out.
Well, I mean, when you're seeing the strength, so the performance hasn't necessarily translated into relative strength improvement in a ranking perspective,
No.
but energy has picked up 20 buy signals so far this quarter, tied with utilities for the most improved sector in our Dolly rankings for this quarter. Utilities has obviously moved up more notably in rank into the top half. Utilities still, or sorry, energy still dead last, but it's, I mean, tied with consumer non-cyclical. It's showing like looking like it wants to move higher.
Yeah.
It just hasn't been able. It was pretty low in RS signals heading into this quarter, but
Yeah, I mean, an
um,
XLE moved back to a buy signal, positive trend. I think it reversed up on its market RS chart. So, a lot of small improvements within the sector, but the longer term relative strength ranking still not good for energy.
Right. And energy, I mean, XLE is one of those funds that, I mean, you have 22% of the fund, or at the end of February, it's 22% of the fund in Exxon and another 15% in Chevron. Pretty top heavy, right?
Yep.
But when those two do well, I mean, you would have that improve. But I mean, obviously, we're not getting into the fundamental side of why those two companies might be improving while oil is moving lower. It is a weird, we don't see this very often. Typically, you see it in the other direction, right? You might see crude doing well while energy stocks aren't. Um,
Yeah, I mean, you see these pretty, and I think, we were talking about earlier, it's one of the widest spreads we've seen
in Q1
in
specifically,
Q1.
yeah.
And I think it's got to close. I mean, that's what these companies do. They sell oil. They have a fixed cost for each barrel they produce, and so either the price of oil has to come up or their profitability is going to suffer, which probably means that the stock price is going to come down. Obviously, that's not always a guaranteed relationship, but
Markets
usually
don't always work out exactly
that
as expected.
that's right. But usually you're going to see that spread close. Now, whether
Right.
it's maybe maybe the market knows something that we don't know. There's a reason to think that crude oil prices are going to come up. But they're talking about a possible peace deal in Russia, which would potentially mean sanctions coming off of Russian oil, which would probably be a supply glut. So I think there's some reasons to be doubtful about, where crude oil goes from here, especially if that, Russia peace deal gets done. But, we'll see what happens.
Yeah, I mean the XLE chart, it's just kind of been not super consistent over the past couple of years. It's just big columns in either direction and just kind of really, I mean, wide but sideways movement throughout really since the beginning of 24 or kind of
Yeah.
midway through 24.
Yeah. Every time you kind of think it's breaking out to the upside, it just kind of turns right back around.
Right. And like you said, we got to break out buy signal back to a positive trend at 94 with movement. Was that this week?
Yeah.
Yeah, earlier this week. But you got a big, I mean, we're at 94 in the chart now. Initial support's not until 85, which is kind of the bottom of that range that it's been at. So it's got a, yeah, it's looking improving, but if things do turn around with the trend and movement that we've seen in it, I mean, there's no reason to not expect it wouldn't go all the way back down to that point. Obviously, we don't know what's going to happen. Could start showing consistency and move higher, but that's an interesting point to kind of keep an eye on.
Yeah, I mean, we've seen kind of the same thing out of crude oil. It had kind of put in a series of lower tops since, I don't know, third quarter of last year. Looked like it broke out in January and then pretty much immediately like reversed down, back down to multi-year lows. So really just not a lot of consistency in energy commodities or energy stocks.
Yeah, I mean, but in another area of the market that has shown consistency though is more in the precious metal space or metals in general, kind of. I mean, gold has been up almost 15% year to
Yeah.
date on the continuous commodity futures there. That is, I've heard more about gold in the past probably 9 months than I have at any other point in my career. It's just keeps kind of marching higher.
Yeah, recently crossed above 3,000 and so far I think it maybe got above there last week and it's kind of held above that mark. You know, you kind of think about gold as a safe haven asset, but gold started moving before there was any kind of trouble in the equity market. Heard people talk about central banks buying it up.
Do
But
you think so on that? Do you think it's like people if buying gold rather than buying like US Treasuries? Or if dollars kind of been weakening, that kind of
I mean, sure, but so typically the relationship people talk about is gold as a non-interest bearing asset versus treasuries as an interest bearing asset. With treasuries, yielding 4 or 5%, it's kind of surprising that we see gold taking off. I mean, you could go buy treasuries and get 4 or 5% on them. I guess people are just betting that gold's going to keep going up. If it's going up 15% a quarter, then obviously you're better off holding gold.
that's beating the yield. Yeah.
Yeah.
But yeah, like you said, I mean, it moved up. I mean, sharp improvement, got into overbought territory, which is gold being in overbought territory again is something that's now the norm over the past few months, but weird. Reversed down, but you just supported that 30-10 sitting there on the chart, reversed back higher. Big stem, big drop after that down to like its 50-day moving average as like in terms of where next support would lie if it did move lower. But um,
Yeah, it's been, I mean, it kind of, we had a pretty strong rally in 2024, and then it looked like it may have kind of been turning around and heading lower, and then it just shot up again. So, where it goes, maybe you can tell me.
I definitely can't. But what I can tell you is that when with some of the other relative strength relationships that we do look at, I mean, I think you mentioned gold versus copper tends to be one of the more frequently examined relative strength relationships with gold, gold silver, gold copper, but the gold copper specifically tends to be more like when gold's improving, tends to be not as great for the economy. When copper's or global economy, right? When copper's doing better, or this chart's moving lower, tends to be better for the economy, at least historically.
Yeah.
Um, Now we're in a point where long-term gold's still favorable. Looking at like GLD versus CPER for those following along. Um, the gold ETF still favored, but copper is at least shown some improvement in the near term.
Yeah, I mean, it hit a new all-time high last couple of days. So seeing some strength out of copper, as you mentioned, theoretically good for the economy. I mean, copper is kind of, you know, wiring, buildings, all of that.
And it's not that gold's obviously with gold's at highs. It's not the on the relative strength side that gold's doing worse, just copper's doing better.
Yeah,
Which is
surprising.
should be good for the economy.
Yeah.
I mean, I haven't looked at that CPER chart in a while, but you have 4.94 fund score, three consecutive buy signals. Pretty heavily overbought territory though, so I wouldn't be surprised to see a little bit of normalization there for copper as a space. I mean, obviously the ETF's not necessarily as indicative of the commodity, but they do go hand in hand.
Yeah, I mean, I think the continuous contract was at 120% overbought yesterday,
Yeah.
so we're getting pretty extended.
And we mentioned gold is up almost 15%. CPR is up 30% year to date.
Yeah.
That's I mean quite the push higher.
Yeah, and I mean, I think a lot of it has probably come in the last 2 weeks because, before then it was moving up, but not that rapidly. And I think we've kind of really seen it move quickly over the last week or two.
Yeah. Yeah. So are there other areas in the commodity space? So we've hit on a little bit of the energy, hit on a little bit of the um on the metals side of things. That's the bulk of action I think we talked about the report wise. Anything else interesting floating around?
Well, I mean, we saw a lot of strength out of agriculture last year.
Right.
Cocoa was the best performing commodity, up about 180% in 2024,
Jeez.
and it is down 31% this year, near the bottom of our continuous commodity matrix. So I think kind of a good reminder that, while stocks, can keep momentum going for a very long time. We have stocks in the system that have been on relative strength buy signals for 15 plus years. Commodities really do tend to be a little bit more cyclical.
Hmm.
They can't develop new sources of revenue. They can't really, they're just a
It's
commodity.
just supply and demand.
Yeah,
That's all it comes down to,
yeah.
right?
And at some point, people are going to say, okay, I don't need that chocolate bar if it's 200% more expensive than it was last year.
Right. I mean, is Ozempic still kind of taking off? People getting on like weight loss stuff. I mean, maybe that's affecting cocoa prices.
Maybe it is.
You don't know. I mean, I will say too, Bitcoin did pretty well last year. Cocoa did pretty well this year. Bitcoin's not doing well. Cocoa's not doing well.
So you think maybe there's a
I don't know if there's any correlation there or causation, but I don't know, maybe people are eating chocolate bars or they're mining Bitcoin and they're not mining as much. And so then who knows? Um, Okay, so a lot of movement on the commodity side, and when we're looking at the daily rankings, we still have domestic equities like firmly entrenched in the number one spot. Commodities sitting there in second, and when you had a lot of the movement in commodities prior to this year of the improvement had been kind of tied to the energy stuff. When energy did well, commodities rose in ranking, but now it's been energy at least the commodity ETFs not doing quite as well, and you have other areas that had like gold that had been kind of ticking it up in the rankings, right?
yeah.
So I think that'll be an interesting dynamic to continue to see if we do see a turnaround in crude or anything like that. And that could make it have more staying power, but at least it's still firmly in that second position. International equities have also shown a lot of improvement recently, but haven't improved at all really in dolly ranking, which I think will be an interesting dynamic to monitor there moving forward. I mean, you have like Europe doing really well. You have China that's showing a lot of consistent improvement. Other areas like India not showing as much improvement, but that was one surprising point to me, given the outperformance we've seen from international equities in Q1. It just hasn't moved at all from the relative strength perspective.
Yeah. Well, I mean, as you know, a lot of these relative strength relationships, so there's a lot of different proxies and, the international equities, they're compared to domestic equity proxies. And a lot of those relative strength charts that kind of drive those rankings, they're going to look kind of similar, right? If you have an S&P 500 representative in there, and maybe you have a Nasdaq 100 representative, obviously they don't move completely in sync, but they're pretty similar. So a lot of those relative strength charts are going to look pretty similar. So
Right.
we could see them move very quickly once they start, I think is the point I'm trying to make.
Yeah, and I guess on the other side too, why we've seen commodity improvement and not international equity improvement is because a lot of those, I mean, both developed and emerging markets from the broader representative perspective, it didn't show a ton. I mean, they were moving around some last year, but it didn't move a ton.
Yeah.
Whereas commodities, they move a lot more. So maybe the relative strength on the other end of that division, you saw some more chart action that led signals to be easier to give in the commodity charts, given the higher volatility you have from the other asset versus not as much so on the equity side
Yeah.
for international equities. So when you get a sell-off in domestic equities, like we saw the correction in Q1, those commodity charts might have been easier to move to buy signals, whereas international equities just not quite the same, right?
Yeah, and I mean international equities, I mean they have a lot of ground to make up. They've
Yeah.
underperformed domestic equities for the last 8, 10 years or so.
Yeah.
So
I was
um,
looking at it like another, again, going back to other quilts. I really like looking at quilts yesterday. But looking at just the historical performance of ACWX and the S&P, we had heading into this week 10% dispersion favoring ACWX relative to the S&P 500, which is its largest again since 2007. Obviously, 9 more months ago in the year, we'll see how we've entered recent years with international equities doing well, which quickly turned around by year end. So we'll see. We haven't gotten a consistency. We'll see how that shakes out as we head into Q2.
yeah, there's been a few times over the last few years where you saw international equities get up to number one, and then almost as soon as it got there, kind of lost it. So it'll be interesting to see if there's going to be some more sustained strength from international equities this time.
Yeah.
It really hasn't been a consistently strong space, probably over the last decade.
Yeah. 10, 15 years. I mean, that'll be definitely a point to monitor. And I don't think it'll be interesting too out there, like obviously we were talking yesterday, the portfolio broader asset manager rebalances, I mean, they're not as profitable for people at the other end of the coin at the end of Q1. I think it'll be interesting to see how that just from a broader allocation perspective shifts at the end of this quarter after you get major outperformance. I think there's a lot of more subjective thoughts floating around in domestic versus international equities right now too. So for those people in the more active management side, I think that would be interesting to see how that shifts at the end of Q1. I know you do the piece that's like the active versus passive management. Um, that I think that'll be a pretty interesting piece to consider and kind of look toward.
Yeah, I mean, obviously the active managers have a tough time in domestic equities. It's a little bit easier for them internationally.
Right.
But I, you know, don't have a crystal ball, but historically, the times that like emerging market managers have done the best are times when China has not done well because it's the largest weighting in EEM.
Right.
So, if they kind of allocate away from the biggest part of that index, and China doesn't do well, they do well. China has had a really kind of a rip-roaring quarter so far. I think FXI is up almost 20%.
Yeah. I mean,
So that at least historically hasn't boded well for active management in emerging
yeah,
markets.
K-Web China Internet ETF, so it's only up 21%
Yeah,
year to
just
date.
21%.
It's just
Yeah,
casual. Yeah.
yeah.
So yeah, a lot to look out there on the top half of the dollar rankings. On the other end of the rankings, though, I mean, it's been some interesting movement in the fixed income space with yields recently too, right?
Yeah, I mean, yields kind of flat over the last couple of weeks. We saw a pretty decent run up at the beginning of the year, a pretty significant down move, and then since then we've just kind of traded sideways. I think one thing that is interesting is we do see inflation protection at the top of the asset class group scores fixed income rankings.
Hmm.
Now, I mean, a lot of these inflation protected funds, I mean, obviously they are made up of treasury instruments and they have relatively long duration. So that kind of drop in rates, it's gonna help them. But the fact that we're seeing them kind of outperform everything else does suggest that maybe people are worried about inflation, stagflation.
Hmm.
So it'll be interesting to see where that pans out. I think there was a lot. We saw some short-term outperformance by inflation protection, in 2022, around that time when inflation was really the hot topic. But we'll see how it pans out. But I think it's definitely interesting. Seems like people are at least a little bit concerned about inflation right now.
Yeah, I mean, it looks like just in looking at the average historical average score for the inflation protection group on the group on the group scores page, highest score level we've seen for that group since 2020 when it was on the way down. So, I
Yeah.
mean, highest score level of score improvement we've seen since the beginning of 2020 when it was on the way up. Obviously, not a great time to be relating current environments to the beginning of 2020, but I mean, the scores are what they are, right? They're just different environments, different score reactions, but that's kind of what's shown us.
The market always seems to be at a bit of a crossroads in March.
That can be the case. Yeah, hopefully we don't have another pandemic breaking out here at the end of the month. So
Hopefully not. Hopefully not.
One other thing that moved around a lot in 2020 that has not or moved in the other direction maybe recently was the VIX, right?
Yeah.
I mean that we had several months there of just consistently lower VIX readings. I mean, it was kind of the thing. It's that meme with like the stick figure poking something and
Do
like
something.
do something. That's
Yeah.
kind of what it felt like with the VIX because it just wasn't moving and it
It,
was it was just continuously moving lower. Then we got a spike. Can we call it that? Moving up to 29.
okay. Yeah. So recently, yeah, it did move up to 29, which is historically, well above the average. But we've had this kind of relief rally over the last, I don't know, 5, 6 trading sessions until yesterday. And it got all the way back down to almost 17. It bottomed out at 17.25.
Right.
So 29.50 to 17 over a 4 or 5 day period. Um, I don't know what that says. I think on one hand you can say, oh, it's good for the market, volatility quickly receded. On the other hand, I think you can say that people are still complacent. There's not a lot of look towards taking out, protection for your portfolio because
Yeah.
the VIX is priced off of S&P options.
Right. Right. I mean, do you think the VIX has as much weight as an indicator now as it did 3, 4 years ago?
Oh, I could talk about this for much longer
Another
than we have.
podcast.
I think that I'll try and keep this under 2 minutes. I think the VIX is artificially lowered these days because there is so much option selling.
Okay.
And I think that just has the effect of pushing down volatility, or at
Because of all
least
these covered call ETFs?
I mean, not just the covered call ETFs, but I mean, I think that that's a big one that, we do have just a lot of option selling, kind of driving down option prices. I think also it hasn't really paid off to be long the VIX or long volatility over the last, I don't know, probably since 2020. And so I think people have just gotten kind of used to selling volatility, and that's just kind of pushing it down, which works until it blows up.
Until it doesn't, right? Like I mean, the last true VIX spike that we saw was the yen carry trade unwind in August of 24. But even that, it was like one of the sharpest move higher since COVID, and then the quickest decline in history. It was like a day, 2 days that it fell all the way back down, right?
Yeah, I think we hit the mid 60s like before the market even opened,
Right.
and it was down I think 15 points by the time the bell rung at 9:30.
I mean that's crazy. I mean, so the drop that we've seen over the past couple weeks, not the same, but still very notable. I mean, we saw consistency. I like zooming out on the VIX to like a 1 point chart. Shows like 3 consecutive buy signals up to that 29 point, kind of top of that more volatile range that we've seen over the past couple of years. And then just turned right back around and is now back below its 50-day moving average.
Yeah, I mean, like I said, I think you can make a case for whether it's good or bad.
Yeah.
But it's definitely interesting that, we can't really seem to get a high volatility regime, even throughout 2022, when the market was really kind of taking a beating for most of the year. There just wasn't a whole lot of sustained volatility.
I mean, we did see it notably higher. It was bouncing around between 20 and 35 for most of that year, which is obviously a lot higher than 10 to 20.
Yeah,
But to your point, it wasn't the VIX then kind of it did seemingly act as a good like when it got down to 20, you sell the market. When it got up to 35, buy the market. It kind of that trade would have worked out pretty well throughout that year.
good oscillator.
Yeah, but I mean, just has fell right back down in 2023, back down into the upper teens. The few brief instances of breaking higher, kind of like we saw last week, and then all of a sudden right back down to the upper teens.
Yeah.
Um, but at the 15 level, I mean, we're at support now on that 1 point chart at 18. The 15 level, though, it seems like it's reached that three other times this year and hasn't been able to break beneath it. Um, who knows what we'll see moving forward. And that,
Yeah, I mean, theoretically, I mean, it should have some kind of low. I mean, there's always going to be some volatility in stocks. I mean, otherwise, what are we doing?
right,
Because if there's no volatility, then it's just cash.
right.
So there should be a bottom limit, but it's just interesting that we don't really seem to ever get into a high volatility regime and stay there, which to as I said makes the possibility that maybe people are a little complacent. There's just no worry or no buying of insurance in case there really is a big sustained downturn.
Yeah, yeah. Well, that'll be a definitely a lot to keep an eye on there as we move into the second quarter of the year. It's hard to believe we're already through Q1. It
It
has
it
flown by,
it has flown by. I can't
especially over the past 2 months, I would say. It's just headline after headline after headline. I'm like, oh, all of a sudden the quarter's over.
yeah, there's been a lot of talk about, different assets giving up all the gains they had made since the election, and it's hard to believe that it's been 6 months, actually over 6 months now, I guess.
Yeah,
Um, so yeah, I mean, time has really flown this year.
yeah. That'll be a it'll be a lot to monitor as we move through Q2. But with that, I think we've gone through enough other assets that we can hit on.
Yeah,
So Jamie, thanks for hopping back on here.
yeah, thank you.
And thanks everyone for tuning in this week. We'll be back next week, touch base on any other action.